Welcome to Matters Financial and Geopolitical from a Frontier, and thank you as always for stopping by. Let me start with macro thoughts. Global liquidity is already below pre-crisis levels. Tide will continue to ebb. And this is really the central problem for emerging markets, is the fact that what was once a golden flood of cheap dollar liquidity is now a receding tide. Iran's rial dropped sharply and forex traders shut shop on concerns over US sanctions. Groups of Iranians gathered in front of several exchange bureaus in Tehran on Monday, but were prevented from entering. Nobody was willing to sell dollars in the current climate. Those interviewed said, leading to a shortage of hard currency. And as I said in August, President Trump seems to be relishing his financial warfare strategies. He has Kisiwani on the run. I said Maduro in Venezuela is being attacked by remote-controlled drones. And I said Xi Jinping suddenly looks ever so fragile. The rial hit 128,000 to the dollar, which is a record low, amidst a deterioration in the economic situation and the reimposition of sanctions by the United States. In August as well, I wrote a piece, Currency Puzzles and a Weaponized Dollar. And I was saying in that article, ever since I was a little boy in shorts in Mombasa, folks have been talking about the hegemony of the dollar and how this hegemony was set to be broken into tiny little pieces. And I think they're going to become very poor betting on that outcome. And I also was quoting Hunter S. Thompson with respect to Kisiwani, Maduro, Erdogan, the edge. There is no honest way to explain it, because the only people who really know where it is are the ones who have gone over. Home Thoughts, Kaepernick is the face of NFL protests and is now the face of the new Nike campaign. The ad reads, "Believe in something, even if it means sacrificing everything." And Nike have always been edgy, and obviously seeing their consumers break on this side has made them encourage them to take this approach. Chuvash cherries and some strawberries too. That's from Peter Frankopan, and don't they look delicious? Our hack lord, who I follow on social media, tweeted this link: ruins of Kilwa, Kisiwani, and the ruins of Songo, Mnara. The remains of two great East African ports admired by early European explorers are situated on two small islands near the coast. From the 13th to the 16th century, the merchants of Kilwa dealt in gold, silver, pearls, perfumes, Arabian crockery, Persian earthenware, and Chinese porcelain. Much of the trade in the Indian Ocean thus passed through their hands. Located on two islands close to each other, just off the Tanzanian coast, about 300 kilometers south of Dar es Salaam, are the remains of two port cities, Kilwa Kisiwani and Songo Mnara. The larger Kilwa Kisiwani was occupied from the 9th to the 19th century and reached its peak of prosperity in the 13th and 14th centuries. In 1331 to 1332, the great traveller Ibn Battuta made a stop here and described Kilwa as one of the most beautiful cities of the world. And there's plenty of photographs that have been posted by UNESCO. And that took me back to a book by M.G. Vassanji called The Magic of Saida. And in that book, Kilwa plays a big part. We return to East Africa and the magic of Saida. Kamal Punja journeys back to Tanzania in search of his first love, the woman Saida. As Kamal walks around his hometown of Kilwa, he recalls his childhood and relives the events that he witnessed. Kilwa was all history, Kamal said, the past haunted from the ruins and graves. It was there in the references to the Germans who had ruled there once, and the slaves who were sold there. He heard it in his mother's tales, and he heard it recited majestically by the old poet, Saida's grandfather. His name was Mzee Omaro Tamim. There were actually 3 Kilwas, the island called Kisiwani, the ancient stone city now in ruins, Kamal's Kilwa, which saw its heyday in the 19th century trade in ivory and slaves, and Masoko, the markets scattered about the main road to the harbour. It is an excellent book. I also had an opportunity to interview the writer. That link is on Rich Wrap-Ups. And let me leave you with a very powerful sentence from that book. The past is a dangerous business, warned Aki Mali. It is best to keep it buried. For every 18 migrants who reached Italy by boat during the first 7 months of 2018, 1 person drowned attempting that voyage. Let's move on to the currency markets. Euro dollar 115.94, losing its perch at 116. Dollar index 95.24. Japanese yen 111.33. That's a very big move from early in the morning at 111.09. Swiss franc 0.9700. The pound 128.50. The Australian dollar, which is, that's rebounding, 0.7222, must have been some data points. India rupee 71.235. Record low. South Korean won 11.1505. Brazilian real 4.1563. Egyptian pound 17.9405. And the South African rand 14.8868. Dollar index, my target is 100. Currently at 95.24. Euro dollar, this chart is from Sun Chartist, and I think we're headed lower here as well, and I think we're headed lower in sterling, and this is another chart from Sun Chartist. We're currently at 128.50 in sterling. Commodity markets, gold I think is going to eventually move below $1,000. Right now it's at 11.98. Crude oil, $69.91, just sitting near that $70 a barrel level, but seems to be underpinned for now, notwithstanding dollar strength and all of that. Another emerging market meltdown. Don't rule it out, Bloomberg opinion. Emerging market stresses have been building since at least 2013. Investors may have forgotten the effect of the taper tantrum on the so-called Fragile Five: Brazil, India, Indonesia, Turkey, and South Africa, a term coined by Morgan Stanley to describe their vulnerability to capital outflows. Monetary accommodation, lower current account deficits, and growth disguise the underlying challenges, attracting more capital to those markets. The textbook recipe for an emerging market crisis requires a large dose of debt, an associated domestic credit bubble, including misallocation of capital into uneconomic trophy projects or financial speculation, then add a weak banking sector, budget deficits, current account gaps, substantial short-term foreign currency debt, and inadequate forex reserves, a season with narrowly based industrial structures, reliance on commodity exports, institutional weaknesses, corruption, and poor political and economic leadership. Based on these criteria, the number of emerging markets at risk extends well beyond Turkey and Argentina. Like Tolstoy's families, each nation has different sources of unhappiness. Total emerging market borrowing increased from $21 trillion, or 145% of GDP, in 2007 to $63 trillion, or 210% of GDP, in 2017. Borrowings by non-financial corporations and households have jumped. Since 2007, foreign currency debt in dollars, euros, and yen, these countries doubled to around $9 trillion. China, India, Malaysia, South Africa, Mexico, Chile, Brazil, and some Eastern European countries have foreign currency debt between 20 and 50% of GDP. In all, EM borrowers need to repay or refinance around $1.5 trillion in debt in 2019 and again in 2020. Many are not earning enough to meet these commitments. Turkey and Argentina have twin deficits, combined budget and current account gaps, as a percentage of GDP of 8.7 and 10.4% respectively that require financing. Pakistan has a twin deficit well above 10%. Brazil, India, Indonesia, South Africa, and Ukraine are at or above 5% on that basis. In India, if state governments are included, the number approaches double figures. Those gauges are rising in China, Malaysia, Mexico, Colombia, Chile, and Poland. Then look at reserve coverage, foreign exchange holdings divided by 12-month funding needs for the current account, short-term debt maturities, and amortization of long-term debt, which measures the capacity to meet immediate foreign currency obligations. Turkey and Argentina score 0.4 and 0.6 respectively, meaning they can't cover their needs without new borrowings. Pakistan, Ecuador, Poland, Indonesia, Malaysia, South Africa have reserve coverage of less than 1. Chile, Hungary, Colombia, Mexico, and India have coverage of less than 2. Brazil and China come in at 2.5 and 3.1 times respectively. Events in Turkey and Argentina show how these weaknesses have become exposed. Turkey and Argentina may be special cases, but given the fundamental problems, other emerging markets are likely to come under pressure. As Herbert Stein's 1976 law states, if something can't go on forever, it will stop. Which is what I was writing about in February this year when I was speaking about the end of Halcyon days. And as by now you know what Halcyon days are. They're those few days when storms do not occur, because Aurelius had restrained his winds and kept them calm during 7 days of each year. February again, in that article I was saying QE is believed to have inflated market valuations as far as emerging, frontier, sovereign, sub-Saharan Africa, and even cryptocurrency markets. And in February, the JP Morgan MB spread was down to 258 basis points, and I was saying this is the tightest since mid-2014. And I was saying how long this will last is anybody's guess. India's rupee closed yesterday at a record low of 71.20, and it's now lower still. India's 10-year benchmark bond rose 5 basis points to 8%. Probably stating the obvious, but the strong dollar hasn't helped emerging markets. David Inglis, EM rout continues with Argentina peso, Brazilian real, and Turkey lira hardest hit. That's from Olga. September 2016, I was quoting Hotel California, mirrors on the ceiling, the pink champagne on ice, and she said, we are all just prisoners here of our own device. Last thing I remember, I was running for the door. I had to find the passage back to the place I was before. Relax, said the night man. We are programmed to receive. You can check out any time you like, but you can never leave. And then, and in the master's chambers, they gathered for the feast. They stab it with their steely knives. They just can't kill the feast. Sub-Saharan Africa, China's Z offers $60 billion in financial support to Africa. Speaking at the opening of a major summit with African leaders in Beijing on Monday, Xi said the figure included $15 billion in grants, interest-free loans, and concessional loans, a credit line of $20 billion, $10 billion for development financing, and $5 billion to buy imports from the continent. Chinese companies will be encouraged to invest no less than $10 billion in African countries in the next 3 years, he added. Government debt from China's interest-free loans due by the end of 2018 will be written off for indebted poor African countries, as well as for developing nations in the continent's interior and small island nations, he said. China-Africa cooperation must give Chinese and African people tangible benefits and successes that can be seen, that can be felt, he said. That's in response to the refrain, you cannot eat GDP. Beijing loaned around $125 billion to the continent from 2000 through 2016, according to data from the China-Africa Research Initiative at Washington's Johns Hopkins University. African leaders in attendance include Ramaphosa, Abdel Fattah el-Sisi, Edgar Lungu, Gabon-Zali Bongo. The only one or two I didn't see was Kabila of the Congo and Magufuli of Tanzania. Before FOCAC, Rwandan President and current chair of the African Union, Paul Kagame, also dismissed concerns, telling the official Xinhua news agency talk of debt traps were attempts to discourage African and Chinese interactions. I told Al Jazeera that concerns over debt trap diplomacy were real. There are worries that this infrastructure has been inflated in price and that it is highly unlikely to make a return on its investment that is necessary for these countries to get in order to pay back the debt. And I was saying the future of China-Africa relations is going to depend entirely on how China manages this debt situation, which is now spiraling out of control. Xi Jinping has actually been quite nuanced in his response to that, you will notice. China's Xi says funds for Africa not for vanity projects, to build infrastructure that can remove development bottlenecks, he said. China does not interfere in Africa's internal affairs and does not impose its own will on Africa. What we value is the sharing of development experience and the support we can offer to Africa's national rejuvenation and prosperity. My piece over the weekend was headlined Africa, the Belle at the Ball. And here's some photographs issued by Uhuru Kenyatta, who in response to the 60 billion said the money will be channeled to projects aligned to the Chinese government's Belt and Road Initiative, covering telecommunication, construction of roads, bridges, seaports, energy and human capacity development. 8 new initiatives, an additional 60 billion, and a cleanup of the debt maturing by this year of its LDCs. And then I came across this tweet from Rage Omar. African bureaucrats refuse to spend time understanding factors influencing pledged funds from China. Instead, they concoct new schemes when old ones fail to fly. By so doing, they've specialized in the inflation of hopes than in the closing of deals. And then the Chinese know exactly what they're doing. Meanwhile, our own leaders go there to naively, gleefully, and with huge dose of inferiority complex, sign up to bad deals. And this is a cartoon, Sino-African relationship best explained. What exactly happened in Arua is a first-person account by Bobby Wine, and I described events in Uganda as being at an inflection point, and saying inflection points are difficult to discern, but this is one right here. Bobby and Barbie have now arrived in the US, but what caught my attention was a video of revelers at a Taros Riley concert who, while chanting people power, threw bottles at Bebe Cool while he was on stage performing and later ended his performance. I said inflection points are difficult to discern, but this is one right here. And then I was saying a debt crisis, which is what I think is going to happen, and a political inflection point where those who fought for independence hand over to the born-free generation is in fact a double whammy. Zambia, the government has all but expelled an IMF official as the debt continues to spiral and the role of Chinese projects in it raises more concern. That is a situation that's spiraling out of control. Local risks worsen South Africa's pain amid emerging market rout. The premium investors' demand to hold South African debt rather than US treasuries, known as the sovereign spread, has climbed 63 basis points since the beginning of August to 330 136, highest level since November 2016. Emerging market vulnerabilities have not eased, in fact they've intensified, which could imply that the rand is likely to remain on the back foot over the near term. You can say that again. And I was writing about that at the end of August when I said the ZAR gets caught up in the crossfire. South African all shares down 1.33% this year. Dollar versus rand, oh dear, we're going to go over 15, target 17. Egyptian pound 17.9465. Nigerian all share down 8.9% so far this year. Ghana is considering a $50 billion century bond, said its president. The Ministry of Finance and economists in Ghana are looking at floating a $15 billion century bond. This will provide us with the resources to finance our infrastructural and industrial development. They are popping quaaludes. Ghana Stock Exchange is up 7.53% this year. Kenya's Deputy President William Ruto just spent 5 million shillings of his own cash on goats at a charity auction in Kajiado. That's 3 months' salary for Ruto. What generosity. That's Adrian Blumfeld. If he keeps doing this, his family is soon going to struggle to put food on the table. He must think of his poor kids. East African breweries raised its stake in Serengeti breweries to 72.5% after converting a 15.3 billion shilling loan to the Tanzanian subsidiary into equity. EABL share price and the full year results, which were slightly disappointing, profit after tax declined 15%, is on rich wrap-ups. Longhorn Kenya bucked the general malaise in the stock market and reported full year earnings per share surged 36.375%. Revenue expanded 16.844%. Admin costs were up 20.421%. Operating profit up 54.67%. Profit before tax up 52.47%. EPS up 36.735%. Cash and cash equivalents at the end of the year was up an eye-popping 3,494%. They said product diversification, entry into new markets, and growth of the digital offering all added to outperformance, growth of operating margin from 16 to 21%, and that the expansion into new territories within Southern Africa and Francophone territories is the next thing they're looking at. These were good earnings, plain and simple. Top 5 digital lenders by market share in Kenya. Mshwari is 1 at 29%, KCB and Pesa second at 12%, Equity Easy 4%, Tala 1.8%, M-Co-op Cash 1.3%. Nairobi all shares down 3.08% year to date, and the NSE 20 is down 14.38% year to date. Thank you for stopping by.